Hello and welcome to the walkthrough video for Chapter 12, where we're going to look at measures for evaluating capital budgeting decisions, measures that use time value of money, and measures that don't. So let's start with the measures that don't use time value of money first: payback period and accounting rate of return. So Juliana is considering an investment proposal with the following cash flows. We have the initial investment on depreciable assets, net cash flows, inflows from operations per year for 5 years, and then we have divestment of zero. That means there's no salvage value at all because we're not going to get any money and we're not have to pay out any money. So that also means that the assets will be fully depreciated at the end of that time as well, especially if you're not expecting any type of salvage value. Now, I'm going to need that information later on, so I'm making a lot of assumptions here, but we have to determine the payback period, the accounting rate of return on the initial investment, and the accounting rate of return on the average investment. All right. So for payback period, I'm going to take the initial investment, and I'm going to divide it by the annual cash flows. They're the same for every single year. So the key to this is how long is it going to take me to recover my initial outlay of cash or my initial investments? I'm going to divide that by annual operating cash flows. Let's see if I can't make this wider. And my initial investment was 74,250. And that will be divided by 16,500. And that's going to give me my payback period. So 4.5 years is my magic number. Fairly straightforward as long as I don't have to worry about the cash flows being different from year to year. If those cash flows change from year to year, that's going to make things a little more difficult. Now, let's look at the accounting rate of return on initial investment. So with the accounting rate of return, it's usually more valuable when I can compare this rate to what the company requires as far as a minimum required rate of return. But with accounting rate of return, it's very similar to ROI, only we're using accounting net income rather than cash flows. So we're going to take the annual operating cash flows and we're going to convert that to net income. So the annual operating cash flows are 16,500. And we're going to convert that to operating income by backing out depreciation. Now, depreciation is not explicitly given to us, but remember I told you that with divestment, there are no costs associated and no income associated with divestment. So that means the asset will be fully depreciated and we'll get nothing for it, which probably means that we are using the straight line method. And with zero salvage value and 5 years, we simply need to take the 74,250 and divide it by 5 years to find the annual depreciation amount. Now, this also asks us for average annual depreciation if I can't find the exact amount. So even if the stuff I said before about it being fully depreciated and zero salvage value, even if that's not true, it's okay. I can still do it the same way because we're taking the average annual depreciation. So lots of flexibility here. So the 74,250 divided by 5 years. And then we're going to take the difference between those two. And let's say less. So that 1650 becomes my magic number. to be used in my accounting rate of return on initial investment. So now I'm going to take the average, let me label this. This should be labeled as average annual increase in net income. So now we're going to take that average annual increase in net income, and we're going to divide that by the initial investment to see what type of return we'll get. So that's the 1650, and that's going to be divided by the 74,250. Accounting rate of return. Oops, can't divide by 0. Selected the wrong cell. Cell 11. And let's take this out a couple more places. How about one more place? Oh, wrong way. So a rate of return, accounting annual rate of return of 2% is what we're looking at. Now let's find the rate of return on average investment. So with average investment, that means I'm not just going to be looking at the initial investment. I'm going to divide my increase in net income by the average of the initial and the divestment. Remember, divestment was 0. There it is right there. So now I'm going to take that average annual increase in net income of 1650. And my average investment is the 74,250 divided by 2. Now, if I had $10,000 in divestment, then it would be 74,250 plus 10,000 divided by 2. So now the accounting rate of return on average investment is the 1650 divided by the 37,125. Now, I'm going to add in a little line here so that when you go back and look at this, you understand that we divided these two numbers. We divided that number. And let me increase my decimal here. So that return goes up a bit when we take into consideration that average on initial investment. Now let's look at some with time value of money considerations. Now, with 1219, we have Kaylee Jane's company is evaluating a capital expenditure proposal that requires an initial investment of $30,723, and it has predicted cash inflows of $5,000 per year for 10 years, and it has no salvage value. Using a discount rate of 8%, determine the net present value. Then we're going to determine the proposal's internal rate of return. We're going to use Excel, not the table approach. And then what discount rate would produce a net present value of 0. So here we go. For a net present value, the first thing that I really need to do is I need to set up a little table here, a table that will include my inflows and outflows. So year 0, goodness gracious. And then year 1, year 2, all the way down to year 10. Now, let me add in a heading so that when you go back to look at this, it makes a little more sense. This is the year. This is the inflow or outflow. Now, my initial investment is negative, so I'm going to put it in as negative. That's the 3723. And then we're going to do 5,000 a year for each one of those years. Now, let me make this look nice because we're about to do the fun part, which is the formula. To calculate the NPV, or the net present value, we're going to use our formula function, NPV. In the first component of the formula, we need to use the discount rate. So we're going to put in the rate of 0.08. And then we're going to put in all of our values. And our values will not include year 0. It will include years 1 through 10. So I'm going to highlight all of those. And then we're going to take into consideration our year 0 outlay of cash. So what the formula does is it does find the present value of all of these items listed here for years 1 through 10. But I'm not taking into consideration year 0 because in the net present value formula, it only includes everything as year 1. There is no year 0. So that's why I have to come in and add this cash outflow. Now I'm putting it in as add because I've already put it in here as a negative. So that gives me my net present value of $2,827.41. Now, what does this mean? It means that when I take into consideration the time value of money, this $5,000 a year is enough to cover what I initially paid out, being adjusted for the interest that I've earned, and still have some left over. We want net present value to be positive. If it's negative, then we would not take on this project. Now let's do internal rate of return. Internal rate of return is sort of the break-even point on a project. In other words, it's the point where the net present value is 0, where the present value of all of my outflows, that one, is equal to the present value of all of my inflows. So now we're going to do IRR. And we don't have to put in a guess. I'm just going to select everything now. And 10% is the magic number. At the 10% level, net present value is equal to 0. At the 10% level, if I find the present value of all of these individual amounts using a discount rate of 10%, then that's when net present value is going to be 0. So in answer C, what discount rate would produce a net present value of 0? The answer is 10% again. Let's add that in. The discount rate of 10% would produce a net present value of 0 because 10% is the internal rate of return. It is the discount rate that would make the initial investment equal to the present value of the cash inflows. And there you have it. All right. I so appreciate your time and attention. If you have questions, reach out to me. I hope you have a wonderful day.